In this video, I'm going to update you on my ISA portfolio.
How's your portfolio? I'd say strong.
There's been a real boost in value and some significant changes over the last couple of months, which have meant I've changed my investment strategy. I'm going to share why and the changes I've made in this video. Apart from the last couple of days, the last 6 months has been a bumper period for investing sensibly in stocks and shares, particularly those with healthy exposure to the US stock market, either directly or through a global index fund, as all the major US indices had an incredible boost over the last year. Like most people, my ISA investments have continued to grow over the last few months, now worth north of £270,000, which is a real testament to how the markets have performed, but also the power of consistent investing and staying committed to long-term investment goals, even during periods of market uncertainty, which I believe we are now in. Before we jump into my portfolio, let's take a look at what's been happening in the market. There's been some considerable changes and they've had a real impact on most people's investment portfolios. So the US market has gone gangbusters over the last few months, especially since Donald Trump's election win. All the major indices in the US have performed well, even the slow and steady Dow Jones Industrial Average. You can see on this slide, we show the S&P have increased year to date 23%, just above, the NASDAQ an incredible 31%, and the Dow over 12%. Incredible returns for the year to date. Inflation particularly has been stubborn, now in November sitting at 2.6%. However, that doesn't indicate the full inflation numbers. If you include the household inflation, that's running considerably higher. So if we look at CPIH, that's actually running at 3.5% and increasing. And the inflation rate stubbornness is largely driven by service inflation. You can see this maroon red line here, stubbornly staying high. So all of this influenced the Bank of England to keep the rate at 4.75 in the recent meeting in December. And the current estimates are that the Bank of England base rate will still reduce over time, but at a slower rate. So despite all these concerns, there are a number of economic indicators that offer a more positive outlook. Unemployment rates held steady, 4.3% in October. That suggests quite a lot of resilience in the labour market. Also, average weekly earnings, including bonuses, saw an unexpected surge to 5.2% in the 3 months to October. And this is the first annual increase in over a year. And of course, that might indicate that consumer spending increases in the near term. Now let's take a look at the FTSE 100 index. It has taken a downturn in the last couple of weeks. So let's take a look at how it's performed year to date. It's up 6.13%, so nowhere near the US indices. And it has trended downwards in more recent times, following a relatively stable period earlier in the year. If you did buy the FTSE at its lowest point in the year, in January, then you'd have got a 10% return. So let's get to my ISA portfolio.
Is that your portfolio?
Overall, I'm really pleased to report that the current value of my ISAs is north of £270,000, an increase of over £15,000 since the beginning of the tax year with no additional contributions. So this is mainly due to the global diversified portfolios that I'm investing in, increasing, largely driven again by the US and AI stock boom. That said, I've made a couple of significant changes to my asset allocation, which I'll cover in a second. Let's start with my best invest ISA portfolio. Looking at the Fidelity Index World P accumulation, I like this fund. It's got a low fee structure and it tracks the MSCI World Index. And you can see here the return over the last year has been incredible at 27.4%. And you can see the returns here for the Fidelity Index World P fund over the last 5 years. Overall, by investing in this fund, I've made over £80,000. So why aren't I investing all my money into this fund? I'm starting to have a few concerns about the US stock market. It's performed extraordinarily well, but the PE ratios for the S&P are high. I'm very conscious that you shouldn't time the market. That's a bad strategy. But I'm also conscious that the US stock market is very frothy at the moment, very high. When you look at the price to earnings ratio, it seems overvalued. It looks overvalued compared to recent history. You can see on this chart, you've got the range of fairly valued PE ratios, and we're high at the moment. At the moment, we're 2 standard deviations above historic trends. Now, there were times when it was higher, just around the internet bubble, of course it was higher, but this is something I'm keeping a close eye on. And what this has led to is me rethinking about, should I have all of my eggs in one basket in terms of being in the equity market? So what I've done is diversified I've taken some of the funds from equity investments and put them into money market funds. Now this gives two added bonuses. Firstly, it gives me some dry powder. If there is a market dip, then what I can do is reinvest into the market with that cash. But secondly, while interest rates are staying high, it's actually a pretty good return we're getting on money market funds. They're not impacted because the base rates are staying high currently. Now, money market funds are part of my wider bucket strategy. It's the cash element within bucket one. Now, I hold 3 to 4 years in there. So I've increased the amount that I hold in bucket one to 4 years because of the frothiness I think there is in the market. And that gives some stability and allows me to sleep at night knowing that I've got that 3 to 4 years of value of assets that will fund my lifestyle, irrespective of whether the markets go up or indeed dip. At the moment, I'm holding a bit more cash than I would normally, with more money market funds, which you can see here. And if you want to know a bit more about my investment allocation approach, you can see a video in which I explain it above. And you can see that the Vanguard money market fund is performing well. It's got over 5% return so far this year, which is adequate for my bucket one cash assets. It keeps me above the inflation rate. So let's move on to my Trading212 account. I like to invest my full ISA allocation right at the beginning of the year, which I did with Trading212. So on the 8th of April, I bought the Vanguard FTSE Developed World ETF. This is an excellent fund. It tracks the developed world, a TER of 0.12%. And at that point, I put 20,000 or 19,999 into the Developed World Fund. However, in November, I wanted to broaden that diversification. And so what I did is I took 10% of that value at that time and put that into the emerging market. So it's a Vanguard FTSE Emerging Market Fund. So now we have a split, 90% developed world, 10% emerging markets. And I've created a video as to why I've done that. Broadly speaking, if you do this split, the 90-10 split, what you get is a fund comparable to the world index. So the Vanguard FTSE World Index, VWRP, for a lower cost with a TER of about 0.13 compared to 0.22. And looking at the value, you can see from the 19,999 that I invested early April, it's now grown to close to 22,000, 21,976. So what's next? Well, I'm comfortable with the funds I'm invested in. I'm going to keep a very close eye on the markets. But now I've got more invested in cash, I can weather quite a bit more volatility than I could before. It also gives me some dry powder. If the markets do dip, I can invest into the market quickly. And of course, we're heading into tax reporting period and the new tax year. It comes so quickly. So I'll be selling from my general investment account to bed and ISA and bed and pension to the full allowance. I also do it for my partner and my daughter, and it means I can move around £100,000 from my general investment account into tax sheltered or tax advantaged accounts. Clearly there's CGT tax exposure when I sell, but over the longer term, the assets, once they've been moved, will grow tax-free in the ISA and only subject to tax when I withdraw from the pension after using the tax-free allowance. So I hope you found this portfolio update useful. I'm always trying to share my journey and be transparent with both the ups and downs and the changes that I'm making.
How's your portfolio? I'd say strong.
I'd love to hear your thoughts and any questions you've got or comments you've got below. And if you're enjoying or getting value from this content, please consider liking, subscribing, and click it on the notification bell and you'll be told about the next video when it arrives. And don't forget to check the links in the description below. There's some great resources and it links to the investment platforms I use. And with that said, thank you for watching.